In the long run, there is no factor which is as important as valuation to the returns from asset classes. And that's because most pieces of information get digested from the market and then slowly disappear. Value is the only factor which, as time moves on, continues to have its value. So the longer your time horizon, the more value matters. We think the basic driver is the fact that fundamentals are actually much, much more stable than market prices. Markets are far more volatile than they need to be. As long as that's the case, we're going to find situations where markets have moved well away from fair value, and the real fat pitches for valuation-based investing are going to come when markets have moved well away from fair value. So as we look at the markets, what we're looking for is situations where the markets have been too volatile. We do see that today. We have seen it over the past 5 years. Even though in general, markets have been going the opposite of the ways that a long-term valuation-based investor would be, they are still creating the opportunities that valuation-based investors need to exploit to make money in the long run. If you look at any given day, whether the market is cheap or expensive, going back as far as we can, the value of being cheap is only 3 basis points. So, okay, 3 basis points, that's not enough to do anything about because your transaction costs are going to be higher than that. But the interesting thing is that one-day return is repeated the next day. Having been cheap the first day is worth 3 basis points the next day and the next day. And a month from now, it's also worth 3 basis points, and 6 months, and a year, and 2 years, and 3 years. So that 3 basis points, which is in the noise for an individual day, over 3 years, turns out to be the difference between making 42% and making 15% for just the cheap half versus the expensive half of all days in the market. And so as the time gets longer, because value is so slow burning, the importance of it compounds in a way that there is no other factor that can come close. The problem with value investing is not so much that it is hard to do in principle. The problem is it's hard to do as a professional investor. Basically, in order for something to be a really, really awesome opportunity for a long-term value investor, it has to have gone from a pretty good opportunity to a quite good opportunity to a really good opportunity, and then to an extraordinary opportunity. Every step along that way, you've got the cheap asset underperforming or the expensive asset outperforming. So just at those times when you've got the best opportunities you're ever going to have, those are the times when the clients are likely to have lost some faith in you and where you as a manager may have lost some faith in yourself. You know, as we look at the various things you can try to do to add value over time, the really cool thing about long-term value is that it's one of the things that is hardest to imagine is ever really going to go out of style. It's one of the things where the markets are going to have the hardest time trying to arbitrage away these discrepancies. And it's one of the things where a really good fundamental understanding of where value comes from, where returns come from, what are the actual long-term drivers of asset returns, gives you a leg up and gives you an advantage. So why are we so passionate about long-term valuation-based investing? We know it works in the long run. We understand why it should work, and we understand the circumstances that are required for it to work. And that combination means we can have far more confidence in that as a strategy than anything else.